Hello and welcome to the Accendo Traders Group. This is our weekend wrap-up trading plan for April 17, 2010. Our website is blog.accendotrader.com, where we put together effective video technical analysis trading plans on a daily basis. That's right, we believe in trading plans to keep us as focused and disciplined traders. It keeps us abreast of what's coming down the market that's going to affect our current and open trades. And as we scan for new trades, we need to know what's coming down. But more importantly, by being disciplined, it cuts down on our research time so that we can have time to spend with our family. Well, the week that was. Well, for the first time in a little bit, we see that we have our three major indexes split. The Dow and the Nasdaq ended up for the week, and the S&P ended down for the week. Now, anybody who was within a stone distance of a TV this week, especially yesterday, know that that has a lot to do with the news of yesterday. Overall, the markets ended the week in a mixed fashion. Basically, after the first quarter earnings results, 7 out of our 10 sectors did fall, led by basic materials and also financials. Again, the news yesterday had a lot to do with that. The economic data had little impact on the market. March retail sales rose. Initial claims did go up to 484. They were expecting 460. And what's important about that is there was a day, Thursday, that you really thought the market might fall. It didn't, and that was with the initial claims and a little disappointment on Google after the market closed on Thursday. Industrial production didn't come in where we wanted it to be. Michigan sentiment didn't come in, so we actually had some weak data. Well, as we all know, the week started off with some good push because Europe agreed to give Greece $30 billion, and China also had GDP growth. So Monday started off good, and Monday through Thursday was actually good, but we had the corporate news of Friday to bring us down. So let's start off. Earnings started off on Monday after the close. Alcoa revenues were a little bit down, but they did beat their earnings per share, but revenue was a little bit down. Intel jumped us off on Tuesday. They had a great report, and they raised their forecast for the year, so we saw some movement off of that. JP Morgan also beat, and Bank of America yesterday, Friday, beat expectations. But the biggest news of the week, I should also say that Google beat their expectations Thursday after the close, but not by as much. We had this, everybody wants Google just to wow you, and I guess the whisper numbers weren't met. But the big news was about 10:30 a.m. yesterday, the SEC filed charges against Goldman Sachs. And basically what they're alleging is that through this company, Paulson and Company, basically what they're alleging is they paid Goldman Sachs to create these credit default swaps that they knew were going to fail, and then Paulson and Company bought insurance on that, and that's how they made billions. So they made this product that they knew was going to fail. Goldman Sachs marketed these products to investors. Investors lost billions. Remember, we're talking about teachers unions, municipal, all these retirement funds lost millions, and this Paulson and Company made billions betting against them. So we'll see. Goldman Sachs says they're going to defend their name, but it doesn't look good. And certainly what that means is, will there be additional charges coming out against, why was it Goldman Sachs? Goldman Sachs was considered to be, above and beyond this. They didn't get hit as much as Bank of America and Citigroup. But the first charges against Goldman Sachs. So it'll be interesting if there's going to be more charges coming. And again, financials lead the market, and so the S&P is down. Why? Because one of the sectors down was S&P. It was a leading sector down, and this Goldman Sachs news. Goldman Sachs took a big hit yesterday, even off of the good earning news. So it's going to be interesting to see how the market takes this. Is this just a one-day news, and people are, they want to get in now that Goldman Sachs down and ride it back up, or is this going to be a spillover into next week? You can see on Monday we have leading indicators. Before the market opened on Monday, we have Citigroup. So will Citigroup's earnings on Monday help spell some of the uneasiness of what's going on with Goldman Sachs? Or on Tuesday before the market opened, Goldman Sachs. So maybe what they say on their conference call on Tuesday will help calm the market. Apple is this next week. Morgan Stanley next week. Amazon. eBay, Yahoo, several companies, again, earnings will drive the market unless the lingering effect of what happened with this SEC. And the thing, here's the one thing I will say, and I'll end with this, is that this came out at 10:30, and although we did close basically at the lows, we didn't come back in the afternoon session on Friday and tank. So the news happened, it was digested, and there wasn't this panic in the afternoon session after 2 o'clock on Friday to keep pushing the market down lower. Last week when we talked about the big days all being down days, and that certainly still remains to be the case. But what's important about with matching all of these up with the big candles and the big days is that on all of them, what happened? Okay, this happened a couple weeks ago, and we're like, okay, here it is. We're finally going to test the 20-moving average. That would be negative. We went up the next day. Oh, we got a little volume. Time to consolidate. Negative. Oh, we finally came down to the 5-moving average. Nope. Oh, here's a push down. Ooh, we finally hit the 10-moving average. Nope. So the thing is, yes, we had a down day. It was very bearish. The VIX rose. That's all well and good. But until we break this 10-moving average, close below it, and then we still have the support of the 20-moving average, which we've been saying for a while is a healthy pullback. As long as we stay above the 1750 range that keeps us above the January highs, it's all a healthy pullback. So what will the sentiment of the traders be with this news? Are they going to expect more financial bad news, more cases? I don't know. But again, we have not closed below the 10-moving average since, what is this, late February. And here we still didn't even close below. There we go. We got a little bit right here, down here. So, we know what we have to basically do is continue to trade what we see. And what we see is we're in an uptrend. We had a pullback day. All the 10-moving averages have been buying opportunities. And on the outer side of our mouth, we had to say a healthy pullback is certainly great for the market. So take that to mean we could go either way. You won't know until Monday and the traders come back. But on most of the bad news, the traders bucked it off, and we continue to move up. Especially Citigroup has good earnings. Let's go over to the NASDAQ. The NASDAQ is showing the big move up after the Intel earnings, after the close. Then we have Wednesday and Thursday, and now the Google news. Google beat, but they didn't beat as much as people wanted. And we're going to see the same type of story here of the 10-moving average. So, again, put an alert at the 10-moving average. Both the S&P, the Dow, and the NASDAQ, put an alert there. If we break below it, certainly you might want to do some type of sell stop thing going on there. Watch your stops. Protect your money your own way. But I think a close below the 10-moving average on the daily chart is certainly important. Let's go to the S&P 500. Uh-oh, what do we see? We see that close just above the 10-moving average. So and what did we see? We saw a mixed market where the Dow and the NASDAQ were up fractionally and the S&P was down. So could the S&P now be leading us down? Why would that be the case? We've been saying this. The financials lead the market. The financials, goldman-sachs takes a hit. If Citigroup can't renew people's faith and, kind of calm the concerns about more cases, and Morgan Stanley is also coming up next week, then certainly we can test the lower. So, we have to look at this 20-moving average as another potential target if we continue to the downside. But again, just like everything else, every time we have that, here we go, buyers come in and take the market higher. So we have to find out which way is it going to go. Which way does the market want to go after this bad news? The important thing long-term wise as we pull out the monthly chart is the psychological boost that we've had by staying above the 50-moving average. So on the monthly chart, as long as we can stay above that level, all is good, and that is around, where are we at? About 10,500. So as long as we can stay above that, I think psychologically the market will say this is just a healthy pullback. If we break below that, I think we may see some retesting that could be dangerous for the market. Dangerous is such a hard word. Could be bad for the market. Let's say that. NASDAQ, we're well above the moving average. That's fine. We talked about this, that this resistance that we're finding at this 2,500 level certainly is holding up strong. Our next support level is going to go back to our old resistance, which is around the 2,300 level. That's fine. And certainly the wicks have been hitting this 10 moving average, and we actually have a ways to go to get to there. Finally, with the S&P 500, again, the psychological barrier of staying above the 50 moving average. We never hit our resistance level up here. And so staying above the 50 moving average would be around the 1150 range. We are out of time for our YouTube folks. If you want to get the full version, make sure you go ahead and download our podcast. Feel free to give us a donation. And, of course, you can lose all your money, trade at your own risk. I'll see you guys next time.